You follow housing really closely. How bad is it?
Well, I don't think it's as bad as it may seem. We are thinking about 2021 and early months of 2022 when we were actually, in some sense, looking in the eyes of a bubble. And ever since mortgage rates surged and reached 6% in June of this year, we saw a quick reversal from those trends. So now we are just recovering from that sugar high that we had over the last couple of years. And naturally, home sales have slowed. There are now about 14% lower year to date than they were in 2021. We are also seeing some deceleration in home price growth, and this is all good. As I mentioned at the beginning of this year, first 3 months were some of the hottest months in terms of housing market competition that we saw historically. So to see some level of normalization in the market, to see more balance between buyers and sellers is in a lot of sense very, very good for the market. And it suggests that we will be having a potentially much healthier market going forward.
Yeah, that's really reassuring. So my natural question is, when is that healthier market going to come to pass? I mean, give us a sense about how these numbers work, whether it's home price sales, whether it's price of homes. How much is it a lagging indicator, a leading indicator? How much momentum is building into the system?
Well, in some sense, yeah, like you said, there is a lot of momentum built in, which is why home price growth reached its highest levels at the beginning of the year after all the buildup in year 2021. So it will naturally take a little while for this, at least according to our Corelogic HPI, which is a repeat price index. It's a little bit different from the median sales index price, and so it does have a lot of momentum. And so, for example, in a median home price, you will already see some home price declines because we've seen pullback in luxury or higher price home sales activity. So that segment is taken out of the equation. So naturally, median home prices are declining or decelerating at a faster rate than that HPI that I was mentioning. But just to give you some sense of where we've been up until this point this year, home prices only in the first half of the year were up 10%. So even if we do see some home price decline over the next few months, we are still on par with where we were in 2021. And in all honesty, from the beginning of the pandemic until now, home prices have gone up 43%. So, it's naturally, with mortgage rates being where they are, 300 basis points higher than at the beginning of the year, home prices up 20%. I mean, average consumer is looking at 50 to 60% higher mortgage payment today than they were even at just the beginning of this year.
Selma, give us your understanding of the relationship between home ownership, buying houses, and rental on the other hand. Because if fewer people are buying houses, then that would indicate to me more people have to rent. And rental has been one of the substantial contributors to inflation, has it not?
Oh, yes, it has indeed. We also do track rents in our single family rent index at Corelogic, and rents have quadrupled as well in last couple of years compared to where they were prior to the pandemic. So in our most recent reading, rents were up 13%. And again, before the pandemic, they were up 4% on average. And so a lot of folks that can't afford to buy a home now are flocking into the rental market. But that was also happening during the pandemic, which is what drove rents up so much because people were migrating. A lot of this price appreciation and appreciation is simply a result of people's migration from more expensive coastal areas to more affordable areas in other parts of the country. And because they have higher budgets and presumably more cash because they sold those high price homes, and now they have more monies to work with and can bid up rents or prices higher.
And finally, Selma, give us a sense of the relationship between the federal funds rate, which is what the Fed is setting, and mortgage rates. I think I saw mortgage rates were up well over 6%, something like 6.29%. I'm not sure where they are today. If the Fed is going toward 4.5% or 5%, does that indicate where mortgage rates might end up?
Yeah, it was very interesting to hear the group express their interest in raising the rates much more substantially than was previously anticipated, which does mean much higher mortgage rates for consumers. Now, those two do move in tandem, but there's been an increase in mortgage rate spread, which means that mortgage rates have gone up much faster than the funds rate, and so that is a result of investors' fears of prepayments. If mortgage rates then in the future go down, there is a prepayment risk, and investors don't necessarily like that. And then there is a concern of unwinding of a mortgage balance from the Federal Reserve that's keeping that mortgage spread high. So at this point, I think we were expecting mortgage rates to remain or oscillate at the 5.5% average. I think with what happened yesterday, we may be looking more closer to 6%. Again, a much higher expense to consumers at this point with those higher mortgage rates.